Walmart's crushing it with a 7.2% gain, while competitors are bleeding red. This retail giant is defying gravity in a down market. But can their digital revolution overcome serious headwinds in general merchandise? Let's dive into the numbers. Earnings dropped this Thursday, with analysts expecting $165.6 billion revenue for the quarter. That's actually up 2.5% year over year, despite all the inflation pressure we've been seeing across the retail. Now, what's particularly interesting is when we look at where this growth is coming from. Look at this acceleration in their e-commerce platform. We're talking 5 consecutive quarters of 20% plus growth, now reaching an estimated 35% this quarter. That's not just impressive, it's outpacing Amazon's 18%. This digital transformation is what's driving Walmart's resilience in their stores themselves. And those digital investments are flowing through to the physical stores. Same-store sales are projected at 4.7% growth in the US, a remarkable resilience despite shifts in where consumers are spending. International locations are keeping pace at 4.3%. This strength is showing up in their share price momentum. Look at this steady upward climb. Nearly 9% in 3 months as smart money positions ahead of earnings. Look at the daily chart. Barely any pullbacks. The weekly chart shows consistent higher lows. Now, the question becomes, are these improving fundamentals already priced in? For that, we need to examine the earnings expectations. Here's where the things get interesting. Analysts have a $1.53 consensus for earnings per share. But did you catch this? The whisper number is running at $1.57. That suggests a potential upside surprise in the making, especially when you consider Walmart's consistent patterns of beating estimate by 3 to 7 cents. The earning momentum is being driven largely by their grocery segment. Walmart's grocery business isn't just growing, it's absolutely crushing competitors by more than 2.3 percentage points each quarter. Target and Kroger simply can't keep up with Walmart's 5.3% expected growth rate. This grocery dominance is a major factor behind their expanding profit margins. Despite the pressure most retailers are feeling on margin, Walmart is expected to expand operating margin by 30 basis points year over year to 4.2%. That might not sound huge, but in the ultra-competitive, low-margin retail business, this is significant outperformance. And there's another storyline that isn't getting enough attention. While everyone focuses on groceries, Walmart's health segment has quietly transformed into a $59 billion business with a stunning 13% compound annual growth rate since 2021. This is becoming one of their highest margin categories and a key differentiator against pure e-commerce players. Speaking of growth categories, their subscription service tells an equally compelling story. Just look at these Walmart Plus subscriber numbers, surging 68% year over year to an estimated 26.2 million members. That's rapidly closing the gap with Amazon Prime and creating a sticky customer base with higher lifetime value. This domestic growth is mirrored internationally, where certain markets are delivering explosive growth. If you're wondering where's Walmart's next phase of growth come from, look no further than India, where their explosive 24.5% growth rate is nearly double their global average of 12.6%. This isn't just expansion. It's a validation of their emerging market strategy that could continue for years. Behind all this growth is a technology story that's easy to miss. Walmart's investment in artificial intelligence aren't just about cutting costs. They're delivering measurable operational improvements across the board. We're seeing 5.4% better inventory accuracy and 32% faster checkout times. These efficiency gains directly impact customer satisfaction and repeat purchase behavior. But there are multiple scenarios investors need to consider. The bull case has e-commerce growth exceeding 40%, with margins hitting 4.5%, while bears worry about the slowing grocery growth under 4% and margin compression. Reality likely falls somewhere in between these extremes. So their AI initiatives could provide unexpected upside. Before we reach a verdict, we need to acknowledge the key risks. As our risk assessment shows, labor costs represent the highest combined risk due to that pose high probability and significant margin impact if uncontrolled. Consumer spending patterns and digital competition also warrant close monitoring. Despite these risks, the analyst community maintains a constructive outlook. Looking at Wall Street's view, we see an average price target of $105, representing 8.3% upside from the current levels. Morgan Stanley is the most bullish, at $107.5 per share or 11% upside potential. But to determine if Walmart deserves this premium, we need to examine how it's valued versus peers. On a forward PE basis, Walmart trades at a modest premium to its retail peers, 24.2x versus the industry's average of 22.5x. However, it maintains a significant discount to the broader market on a price-to-sales basis, trading at just 0.75x versus the S&P 500's 2.42x. This valuation context brings us to our final analysis. After weighing all factors, the strong e-commerce momentum, grocery outperformance, improving margins, and international expansions against the potential headwinds, our verdict is accumulate Walmart with a $105 price target. We assign a 60% probability of reaching this target within 6 months, driven primarily by continued e-commerce strengths and operational efficiency gains. Hope you found this analysis valuable. Let me know in the comments if you're buying, selling, or holding WMT heading into the earnings, and just share your reasoning. I'm especially curious what you think about their e-commerce growth versus Amazon. Hit subscribe for more earning previews coming up, and I'll see you in the next one.